In the intricate world of finance, few indicators hold as much weight as government bond yields. These yields, essentially the return an investor receives for lending money to the government, are akin to a financial barometer, reflecting the overall health and stability of an economy. For China, a nation striving for sustainable growth, understanding and managing these yields is paramount. Government bonds, issued by the Ministry of Finance, are seen as a safe haven for investors. When they purchase these bonds, they are essentially lending money to the government. In return, they receive periodic interest payments, known as coupon payments, and the principal amount at the bond's maturity date. The yield on a bond is inversely proportional to its price. When bond prices rise, yields fall, and vice versa. This dynamic relationship is influenced by a multitude of factors, including inflation expectations, interest rates set by the central bank, and the overall economic outlook. For China, a country navigating complex economic waters, monitoring and managing bond yields is not just an economic exercise, it's a strategic imperative. The stability of these yields is intricately linked to the nation's financial health, influencing borrowing costs for businesses and individuals alike. At the helm of China's financial system stands the People's Bank of China, or PBOC, tasked with the crucial responsibility of maintaining economic stability. One of the PBOC's key tools in this endeavor is its influence over government bond yields. By adjusting key interest rates and implementing monetary policies, the PBOC can steer these yields in a desired direction. The PBOC's primary lever for controlling bond yields is the open market operations. Through these operations, the central bank buys or sells government bonds in the open market. Buying bonds injects liquidity into the system, driving up bond prices and pushing yields lower. Conversely, selling bonds absorbs liquidity, causing bond prices to fall and yields to rise. Another key tool at the PBOC's disposal is the Reserve Requirement Ratio, or RRR, for commercial banks. This ratio determines the amount of funds banks must hold in reserve, directly impacting their lending capacity. Lowering the RRR allows banks to lend more freely, potentially increasing demand for bonds and lowering yields. The PBOC's management of bond yields is a delicate balancing act. On one hand, lower yields reduce borrowing costs for the government and stimulate economic activity. On the other hand, excessively low yields can fuel inflation and asset bubbles. The PBOC must carefully calibrate its policies to maintain a stable financial environment conducive to sustainable growth. In the world of finance, risk and return are two sides of the same coin. Investors constantly seek higher returns, but higher returns often come with higher risks. This is where government bonds, particularly those issued by China, stand apart. They are considered a safe haven asset, offering a relatively low but guaranteed return. Commercial banks entrusted with safeguarding people's savings are naturally drawn to the security of government bonds. These bonds offer a near zero risk of default, meaning the government is almost certain to repay its debt. This makes government bonds an attractive option for banks to park their excess reserves and meet regulatory requirements. Beyond their safety, government bonds offer another advantage: liquidity. They are easily bought and sold in the secondary market, allowing banks to quickly convert them into cash when needed. This liquidity provides banks with flexibility in managing their assets and meeting unexpected demands. The preference for government bonds by commercial banks has a direct impact on bond yields. High demand for these bonds drives up their prices, pushing yields lower. This dynamic creates a virtuous cycle for the government, allowing it to borrow at lower costs. Section 4, A Tale of Two Bonds, Government and Local Debt Intertwined. While government bonds often steal the limelight, the Chinese bond market encompasses a broader spectrum, including bonds issued by local governments. These local government bonds, used to finance infrastructure projects and other public services, are intricately linked to the fate of their sovereign counterparts. The yields on local government bonds are often influenced by the yields of government bonds. This is because investors perceive local government bonds as carrying a slightly higher risk compared to central government bonds. Consequently, local government bond yields are typically higher to compensate for this perceived risk. When government bond yields rise, signaling investor apprehension about the overall economy, local government bond yields tend to rise as well. This rise in borrowing costs can strain local governments, potentially impacting their ability to finance essential projects and services. The interconnectedness of government and local government bond yields highlights the importance of a stable and well-functioning bond market. Excessive volatility in government bond yields can cascade down to the local level, impacting the financing of crucial infrastructure projects and potentially hindering economic development. Section 5. Uncharted Waters: The Risks of Unstable Bond Yields. Stability in bond yields is not just an abstract financial concept, it's the bedrock upon which a nation's economic well-being rests. When bond yields become volatile and unpredictable, it's akin to a ship losing its rudder in stormy seas, creating uncertainty and undermining confidence in the economy. One of the most significant risks of unstable bond yields is the impact on borrowing costs. For businesses, both large and small, bond yields directly influence the interest rates they pay on loans. When bond yields rise sharply, it becomes more expensive for businesses to borrow, potentially stifling investment and job creation. The ripple effects of volatile bond yields extend beyond the business realm, impacting individuals and households as well. Mortgage rates, often linked to bond yields, can fluctuate, creating uncertainty for homebuyers and potentially impacting the housing market. Unstable bond yields can also undermine confidence in the currency. When investors perceive an increased risk in holding a country's bonds, they may sell off their holdings, putting downward pressure on the currency. This can lead to capital flight, further destabilizing the economy. Section 6. Conclusion: Stability through Vigilance, China's Balancing Act. In the complex symphony of China's economic development, government bond yields play a pivotal role. They are not merely numbers on a screen, they represent the confidence investors have in the nation's future. Maintaining stable bond yields is not optional, it's essential for ensuring sustainable growth and financial stability. The People's Bank of China, as the guardian of China's financial system, bears the weighty responsibility of steering bond yields in a direction that fosters growth while mitigating risks. It's a delicate balancing act, requiring vigilance, foresight, and a deep understanding of the interconnectedness of global financial markets. As China continues its journey towards becoming a more prosperous and influential global player, the importance of a stable and resilient bond market cannot be overstated. It's the foundation upon which China's economic dreams are built, a testament to the nation's commitment to fiscal prudence and long-term stability.